Hello, everyone, and welcome back to the Banker Next Door. I'm your host, Dr. Joe Berquist. Today, I wanted to share with everyone an excellent article that I had just read from the magazine publication called Bank Director. And this article is basically, the gist of it is basically loan workouts. But I thought this article was just excellently written, and I wanted to share this with everyone. So I'm going to bring this in. So this is a magazine article. If it's a great publication called Bank Director. If anybody has not had a chance to check this out there in the banking world, I highly recommend it. I have been a subscriber to Bank Director and read a lot of their stuff all the time. It is just an absolutely fantastic publication. So this was kind of an article that was out of the normally published magazine, which only comes out like once a quarter. So it's a quarterly publication. But this was called Credit Storm. And I just thought that this article was great because it basically breaks down the fact of what's happening right now in the banking industry. Obviously, commercial real estate is a big question mark right now. You've got delinquency, which is starting to build because of the inflationary environment and the rising interest rate environment. So what this eventually is going to lead to is a deterioration in what's called credit quality. In other words, your loans are going to begin to go bad. And what this article basically delves into is that not only do banks not really have people that are accustomed to doing loan workouts, it's been a long time. I mean, the last time we really saw a lot of loan workouts was back during the Great Recession, the financial crisis of 07, 08, 09. And the workouts from that really drug on for many years thereafter. I mean, even in 2010, 2011, 2012, I mean, banks were still working on, trying to work out and fix a lot of the problems that it happened. Obviously, it was a massive hit to the financial system that occurred back then. But what's unique about this time is that we have not really seen an inflationary environment coupled with a rising interest rate environment. I mean, you'd have to go back to the 70s and the very early 80s to run into an environment like this. And that's kind of the point. So I'll just read a comment here. So it says in here at the beginning, Mike Kubacki, who is the chairman of $6.5 billion Lakeland Financial Corp., he had a realization. So Mike looked around the boardroom and said, I may be the only person in this room that has ever actually been involved in business during an extreme inflationary environment in combination with a rising rate environment. Meaning, unfortunately, Mike's probably an older gentleman. I don't know how it doesn't say exactly how old Mike is, but I would be willing to say Mike's probably in his late 60s or early 70s, and he was probably around, probably a very young banker back in the 70s and early 80s when a lot of this stuff was, when you go back to a previous or similar type of economic environment. So what they go on in the article here to say, though, is that basically that, hey, look, loans are going to continue to deteriorate. This is going to be a multi-year process. Some banks are going to struggle in this in large part because that they really don't have people experienced in doing workouts and loan workouts. And then they go on to basically say that, hey, the good point is that we've got a lot more things that are disposable right now. Like, in other words, banks have a really strong amount of equity right now that really good capital positions, which is really helping. But they've also switched to what's called the CECL model, the current expected credit loss model. And I'm going to end up doing a whole nother podcast episode just on CECL to kind of explain like what that is and how it works. But basically just think of it like this. It's the operation for how banks manage their loan loss reserves. In other words, every bank has to put a certain percentage of think of it like a pot. You've got a pot on the side here for what's called expected credit losses. In other words, every loan that you make is not going to be a good loan. Like, you're going to make a couple bad ones here and there, and therefore you've got to have a pot of money sitting over here to kind of cover those losses when they do occur. That's the gist of it, the general idea. Again, for anyone out there who's not necessarily into banking, or doesn't work in banking, rather, I should say. So then they go on here and basically say, hey, we've got strong capital. We got this new CECL process for basically how we calculate the amount of money that we put into our loan loss reserves. So the industry's feeling pretty good about that stuff right now. Um, so as we go down here, I just want to get into so then, yeah, they just kind of make some general comments on here, like, like in other words, like a customer, like they may be current on their payments, but if they're not generating enough cash flow to cover their debt service, you need to probably downgrade that loan. So in other words, what generally happens is every bank has a rating system for their loans. Usually it's, 1 through 10 scale. Usually a sufficient loan, like a really strong loan would be like a 1, 2, or 3. That would be a super strong loan. There's probably about 10% of your loans fall into that category. The majority of your loans are going to be like a 4, 5, or 6. There or I should say, I shouldn't even say it, probably a 4 or 5. 4 or 5 is probably going to be, your standard. When you get to a 6, 6 might be like watch list, and now you get to like a 7, an 8. That's basically like non-performing, and then you basically get to substandard, meaning that non-performing means maybe you're getting some payments, but they're not paying like normal. Maybe they're 60 days, 90 days, 120 days behind, and maybe they're making payments sporadically, that kind of thing. So when you get down to 8, you get down to substandard, and that now you're basically at now, like, look, now they're not getting paid, and now you're getting down to maybe the 9 and 10, where it's like, okay, now we're in charge off mode, where it's like this thing's getting, we're foreclosing on the property, we're taking a credit loss on this, and then we're gonna divest ourselves of that asset, of the property, and then see what we can get back for it at a later date. So, and then it goes on to talk. So basically, it's saying here that, like, how, you're going to have to be mindful of, like, in other words, don't get caught off guard. Like, even if a customer is making payments like normal, you got to continue to monitor those credits, because they could still deteriorate kind of under your nose without you really knowing what's going on. And then it gets into, basically banks should consider stress testing their portfolio. You've also got, as it relates to real estate, you've got cap rates. You could kind of look at the cap rate of the property and get in there. And then it says, like, staying on top of the data and working with the borrower gives lenders the necessary information to help the client and protect the bank. Okay, fair enough. But what I wanted to get down to was what's said basically at the bottom here. Hold on, let me get down here. Let me scroll down here. Okay, so where's the part? Hang on, sorry, I kind of lost my spot here for a second. Okay, so then this one guy basically goes on to say here that an early career in loan workouts was a great education in building relationships and minimizing risk. But after years of pristine credit quality, the industry has fewer and fewer experienced workout pros. Many lenders didn't even experience the 2008 financial crisis, much less the turmoil of the 80s. And the once prolific credit training programs offered by the industry disappeared long ago. That I felt was probably like the most important couple of sentences in this entire article. So yeah, I would basically say early in my career, I think the best experience that I got was I had to spend 6 months working in a workout department of a what I would call a large super regional bank. It was a 52 billion asset bank, pretty sizable bank operation. I had to spend 6 months working in the workout department, and that is the probably the best education if you're going to be a credit analyst, or if you're going to be a lender someday, or maybe even rise up to the C-suite, being like a chief credit officer or chief lending officer, something like that. There is no better education than working in a workout department, because you get a feel for how quickly loans can go bad. And there's a pattern. There's certain things that you see, like, mess ups in how the loan was structured from the very beginning, mess ups in the underwriting, things that were missed right away, things that weren't keyed in on necessarily. But basically, it's saying that there are few workout pros in the industry. I wouldn't necessarily disagree with that. Many lenders didn't experience the '08 financial crisis. This is true. I mean, if you've only been in banking for 10 years or less, I mean, you really you missed all that. Much less the turmoil of the '80s, which was, you're talking about 45 years ago at this point. and the once prolific credit training programs offered by the industry disappeared long ago. That is in and of itself an entire conversation about how the credit training in the industry has completely gone by the wayside, which is something that upsets me very greatly. I was lucky enough, 20 something years ago, 23 years ago, when I got into commercial banking, I actually went through like a 9-month credit training program where I got fully trained as a credit analyst before becoming and then getting in and basically doing commercial underwriting of loans. And these are some of the problems that the industry is basically going to get smacked in the face with here very shortly. The lack of credit trained individuals, the lack of people that have workout experience, the lack of existing workout professionals in the industry. These are all things that are coming down pretty much down the pike. Now, here's an interesting comment here, though. It says, a workout artist has a special touch. No doubt. This individual isn't looking for a tough banker who will simply foreclose on a property, though sometimes that must be done. Instead, he wants an empathic professional who can foster a relationship with a problem borrower. Yeah, I would say my experience that sounds like somebody who's never really done a lot of workout, and that is very wishful thinking. Workout people have a very specific personality profile. They are unempathetic people. If I was going to hire a workout professional, I do not want them to be empathetic. I want them to go and foreclose on loans and do what needs to be done to try to clean up the bank's loan portfolio. That may sound very harsh. That may sound very uncaring, but that's a reality of banking. If you get into one of these economic cycles in which you have a big downturn or a recession or a depression or whatever the case may be, and you've got a lot of bad loans on your books, well, you've got to work very hard to clean those up. And it all sounds great being empathetic with borrowers and things like that until borrowers declare bankruptcy, they stop talking to you, they flat out disappear. Then you're left as the bank trying to clean up this huge mess. It could be a very, very difficult thing. Then the article goes on to say basically a foreclosure can be a huge distraction for a bank. Yes, absolutely. Now, why is that? Why would a foreclosure potentially be a huge distraction for a bank? Because or foreclosure is something that takes years and years. A lot can depend on the individual laws of the state that you're in. Commercial can work a little bit faster because of the disclosure for confession of judgment language that's in place in a lot of the loans. But if you're foreclosing on a residential property, I mean, some states have very strict laws with that in terms of like when you can file certain motions, when you can do certain things. You have to bring evidence and prove default and do other stuff like that. So that's a process that can linger on for literally years. And as all this is going on, you've got senior executives dealing with these workouts. You've got the bank's attorneys working with these workouts, costing the bank a ton of money, not only in non-performing loans, but in legal fees. A lot of times banks have to step in. They got to pay money to take care if there's real estate involved. You got to pay the taxes. You got to pay the insurance. You might even have to pay somebody to go over and manage the property for you for whatever time that you have possession of it. So there's a lot that goes into that, and it can be a very, very troubling time in there for any bank. So the article kind of wraps up by saying, the FDIC reported a similar increase for all insured institutions over the same period, with the cost of funding climbing 131 basis points. So basically saying there that that the bank's cost of funding is also going up, which could add different challenges to this thing. And then it goes on to say this appetite contrasts with the Federal Reserve's 2023 Senior Loan Officer Survey on bank lending practices, which found tighter underwriting standards and reduced demand across loan types, including commercial real estate and C&I lending. And it says this person, Rose, Rose has seen some disbelief from borrowers that rates are as high as they are. There's still some institutions that are doing those low rate deals. They're letting them walk. I don't know. I'm not sure about all that. But then it gets back to the person at the beginning. So that the double digit interest rates of the 1980s remain fresh in this person's memory. and he's preparing his lenders for higher for longer until the Fed wins its inflation war. This means the pressure on CRE could take months or even years to resolve, and that's the $1.2 trillion question out there right now at the moment. So yes. And I just want to say real quick, the authors of this article are Emily McCormick, who's an excellent writer, by the way, and she's the vice president in editorial, vice president of editorial and research for Bank Director. So, and again, the magazine's called, the article is called Magazine Exclusive Credit Storm. It's from Bank Director. And so basically, again, workouts here. I think the industry has a problem coming here in terms of not having enough workout professionals, not having enough people, perhaps with the proper credit training coming down the pike. So, and basically what the article is espousing is that, like, hey, you need to, these problems are coming. If you're a smart bank, you need to get ahead of this stuff. You need to get kind of ahead of the curve. Make sure you're stress testing. Make sure you're looking at different types of data. You have a lot of data in front of you. Make sure your loan loss reserves are sufficient. You have sufficient capital levels. All those kind of things to kind of like the storm is coming. Brace for impact. And that is the big. I mean, obviously the higher interest rates stay for longer, the longer that inflationary pressures remain out there, remain elevated. This is obviously going to continue to put more and more pressure on commercial real estate, particularly office properties. And we're all just going to have to wait to see how that plays out. But again, the workout thing is a very interesting. I think it's an aspect of banking that doesn't really get talked about that much, and that's why I really love this article and thought that was something really important I wanted to try to explain to people. So so I basically say it like this: if you have any comments or any thoughts on workouts, please leave them in the comment section below. I'd love to hear some comments. I'd be happy to try to get back to you with some of my feedback, let you know what I'm thinking. But to kind of wrap things up, if you enjoyed this video, please give us a thumbs up. Make sure to check out thebankernextdoor.com. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please check out some of the crypto series that I just did, some of the other videos that came out. I just did some reviews on, I just did an episode on Big Vape, doing the review of the Netflix limited series that came out. I also did a review of the movie Blackberry, if you haven't seen that yet, if you want to check that out. And definitely more videos coming in the weeks ahead. So if you're enjoying the channel, please give a like, please give a thumbs up, please make sure to subscribe and leave a comment. That kind of stuff always helps the channel. And I thank you so much for listening and watching. And I look forward to seeing everybody again next weekend. Thanks a lot. See you later.